Hello and welcome. Today we'll be talking about the trade-offs between risk differentiation and capital optimization in credit risk modeling. We'll be focusing on models that predict the probability of default under the IRB approach. In this paper, I argue against the common wisdom that says that a more predictive model is always better. We'll see how in the face of a choice between two models, the worst one can actually lead to lower capital requirements than the better one. Using a very simple framework, we'll see that capital inefficiencies may reach up to 4%. So let's jump right in. Under the IRB approach, capital requirements are established using the risk weight function right here. We can summarize it with this expression, which shows that capital requirements, or the risk weight, can be expressed using equation 1, where the loss given default acts as a scaling factor of a function of PD. Here we have its graphical representation for different values of LGD. The vertical line shows the PD that maximizes the function. The most important thing to notice here is its concavity. The shape of the function is what underpins the whole industry of regulatory credit risk models, because it incentivizes financial institutions to develop better models. Let's see how. Using Jensen's inequality expressed here, we know that whenever we split a portfolio in half, assigning a high PD to one segment and a low PD to the other, the resulting capital requirement will always be lower. We can see this graphically. The average of the Ks of the two PDs is always below the function itself. Essentially what's happening here is that the decrease in K caused by the low PD is of a larger magnitude than the increase in K caused by the high PD. This is all to say that the way for financial institutions to reduce capital requirements is developing better models that discriminate risk better than the previous ones. However, this principle is not absolute and cannot be taken to mean that a better model is always optimal. Facing the choice between two models, the better one according to metrics such as information value or AUC might actually lead to higher capital requirements than the worst one. To illustrate this point, let's consider a simple example. Let's say our portfolio is split in half. There's a good grade with a PD of say 5% and a bad grade with a PD of 10%. Now the risk modeler faces two discrimination strategies: to split the good grade or to split the bad grade. If we choose to split this grade, depending on the quality of the information available, we'll be able to discriminate among exposures. For example, if this delta parameter is equal to 1, this will mean that we can split the good grade into a subgrade with a PD equal to 4 and another one with a PD equal to 6. If delta is equal to 2%, then we would have 3 and 7, and so on. A higher delta means access to better information. So the higher its value, the better. And the same thing goes for splitting the bad grade. Now what happens when we increase delta? Two things. First, capital decreases thanks to the concavity of the risk weight formula that we have seen before. Second, information value increases because we are discriminating better. This can be seen in this graph. Delta is in the horizontal axis, and the solid lines show the evolution of capital requirements, and the dotted ones show the trajectory of information value with an inverted axis. Let's focus on what happens when we split the good grade. For small values of delta, the decrease in capital requirements is barely noticeable. However, IV increases right from the start. For higher values, the K curve starts to pick up and ends up meeting the IV curve. In contrast, for the bad grade, the K curve and the IV curve move more closely together. Now let's consider two splits with the same information value. For example, this one and this one. They are at the same level, so they have the same IV. However, they do not have the same value of K. For the split of the bad grade, K is here, but for the good grade, K is all the way up here. In this comparison, splitting the good grade would not be an optimal choice. This is the main point. Two segmentations with the same IV have different K values. Now let's generalize it to get a sense of where we can find the major inefficiencies. In this last section, we'll be measuring the size of the inefficiencies across every possible combination of PD good and PD bad. Please remember that we are referring to the PDs of the two initial grades. For every combination, there will be a maximum discrepancy in K, and this is what we want to capture. More formally, let's define a maximum penalty function that selects the maximum difference between capital requirements for combinations that have the same IV. It's important to impose the condition of equal IVs because it implies that the financial institution sees the two models as equally preferable. This is a key point. The values of the function can be seen in this graph. We get the highest values around this area and the maximum right here, marked by the red dot. The details of the maximum are summarized in this table. So the good PE is 6% and the bad PD is 17%. And the first delta is 5% and the second 11.6. For these values, the two segmentations have the same information value. But what happens with K? The first one is 0.667 and for the bad one, it's 0.41, which means that the financial institution, if it chooses the first one over the second, it would be obligated to hold 4% higher capital than necessary. Alright, so this paper has shown that capital inefficiencies can reach a substantial magnitude. It would be interesting to explore other metrics, such as AUC, and other additions to the simple framework here proposed would be to increase the number of grades, the risk dispersion, and to play with the distribution of the exposure. Hopefully, we'll explore this in the future. If you are interested in these results, please check out my GitHub with the link in the description. Here you can access the paper and the code. The paper is just a PDF, and the code is contained in a Jupyter notebook, where you can see how I generated the graphs. Thank you very much, and I hope to see you soon.